So thanks for joining everybody. Our bi-weekly commercial meetup. Yep, still on Zoom. It still works the best because we can gather our people from all corners of the regions, right, in Southern California and further out, wherever you guys are. So today we have our friend with CoStar. Got Ricky, got Ryan, and they're gonna take us through, I guess, what's gonna be like a quarterly recap, financial recap, Ryan?
Yeah, so I'll go through what's going on with the four main food groups, as we call in commercial real estate. Start with multifamily, office, industrial, and wrap up with some thoughts on retail.
Awesome.
And then I can walk, and then after Ryan's done, I'll walk through a couple of new enhancements on CoStar, financial statements and loan data, and that's it.
Sounds like a great plan as always, guys. Thank you so much. So screen is yours, Ryan. Lead on.
All right. Do you see it?
Yep.
Awesome. I'll move that over here. So good morning, everyone, or good afternoon, I should say. Ryan Meny Attias here, Senior Director of Market Analytics. Let's talk about what's going on in commercial real estate. So, up until now, I would say we've had a very strong industrial and multifamily sectors, and we've had obviously the pains going on with office and some green shoots with retail. So, definitely a mixed bag going on. But the one thing I would say that is different from if you were to talk with me 2 or 3 months ago, is I think there's a little more caution now with what's going on in industrial and multifamily. We're clearly getting to a mature point, and potentially with what's going on in the economy and the uncertainty there, could see some changes going on. But let's start. Sorry, let me get this. There we go. All right, multifamily. So this slide looks at the supply, demand, and vacancy for Los Angeles. We had a very weak 2020, very strong 2021, and positive conditions have persisted in 2022, but certainly at a more moderate pace. But the market is tight, and there clearly are limited options in most areas of the metro, limited availabilities, especially when you get to that more affordable workforce housing. LA was a laggard in the recovery compared to most other markets nationally, but I would say at this point it's starting to relatively outperform. We have seen vacancy increase more in other markets this year, particularly those that have seen a lot more supply than we do. And so there has been an increase in the vacancy here during the past several quarters. Now, this graph looks at vacancy by the various submarkets, breaking LA County into various areas. And most areas are historically tight still. And typically we see the more affordable, some of the more affordable markets are those that have the lowest vacancies. It speaks really to that workforce housing, the greater pool of people that can afford units in those areas versus the more expensive. But all areas are relatively tight, certainly compared to 2 years ago, and certainly compared to historical averages. In terms of the outlook, I definitely think that there is some uncertainty here, but we do anticipate vacancy continuing to decline incrementally through the rest of the year before increasing. I think regardless of that, we do expect conditions to continue. I think there is more uncertainty, though, to this forecast, given the economic volatility that we have seen, but this just kind of gives you a baseline here. And nationally, we do expect vacancies to continue to rise. There's definitely more concerns around supply in some of the other markets, particularly the high growth Sunbelt ones. And so that we'll see vacancy kind of get back to where things were pre-pandemic under this scenario. Now, looking at rents for Los Angeles, we have seen rent growth start to cool. And on a year-over-year basis, rent growth in the third quarter ended at just under 5%. But when you're looking at it on a date, we have daily series, we actually have seen rents peak and are now starting to decline. But when you compare rent growth in LA versus the other markets, really have seen outsized gains in those higher growth Sunbelt, Florida, Texas markets. Those have really been the winners there. And LA and a lot of the other coastal markets have relatively lagged. So just kind of showing that picture here, but things are starting to cool. And we are seeing declines in those markets, but on a year-over-year basis, it's still showing pretty strong growth. But 2 quarters ago, Miami, Orlando, those were 20 to 25%, so clear deceleration. Now, looking at rent growth by various submarkets, things have definitely cooled. We were seeing gains much higher towards the top end a couple quarters ago, and so that range has definitely narrowed. Most areas are seeing rents start to decline or plateau, so we are reaching kind of a mature phase for the multifamily sector. And this graph here shows daily asking rents. And so they peaked in around August and have been slowly in decline. So it'll be interesting to see as we go into the end of the year. This is typically a slower season, the seasonality with the apartment business, but we are seeing declines at this point. Now, in terms of the outlook, we do anticipate gains to persist, relatively modest at that. But I do think there are some question marks now as we're seeing in the latest data. But if we do expect the market to remain as tight as it has been, then you do have to expect some positive momentum. And then this would be what we're seeing now, a short-term blip. But we shall see in the coming quarters. Now, in terms of deliveries, LA saw just around 9,000 units delivered during the last 4 quarters. So that would be at the end of September 2022 to the beginning of October 2021. And so relatively, that puts us in the top 10, but we are, of course, a large metro. And so this graph looks at the inventory on a percentage basis. So it's a little complex here, but the number is the absolute number of units that were added in the respective market. And the blue bar represents the percentage growth. And so we are seeing a low percentage inventory growth in this market. That's typically what we see. We have less population gains. We've seen declines recently, but we are seeing continued household formation that has absorbed that demand. So we do need housing construction still, by all means. But it is, but levels are pretty modest when you compare them to the rest of the country. Now we have around 28,000 units under construction right now. That puts us kind of in the top 10. But that's pretty in the middle when you consider on an absolute basis, like that graph I showed you before. A lot more construction going on in those higher growth Sunbelt markets. That makes sense given the growth that we've seen, but there has been shifts in those areas too. And if there is, if we are to see the economy weaken, those areas will be more susceptible because they have seen that much more, they have that many more units under construction on a percentage basis. Now, this graph looks at starts, the number of units that commence construction during a respective quarter, that yellow line, and blue, the thousands of units that are under construction. And so we're still running near peak levels of construction for LA. We certainly could use more housing. The construction is concentrated in the higher end 4- and 5-star segment, as we call in CoStar. That's kind of your class A, class A minus. But starts have notably moderated, and I think whether that's, I think probably that's some of the supply chain issues, but now we may be seeing some sentiment turn off, but we're still at peak levels. And so these units will need to be digested in the coming quarters. Nationally, we see record levels of construction right now for multifamily units. This is all-time records. So in terms of the supply picture, it's definitely more of concern if economic conditions were to deteriorate for most other markets relative to LA, because we just don't have that supply. Wrapping up with sales volume, have seen very strong sales activity, and Q3 was the lowest for this quarter of 2022, but still historically strong and not too much of a signal there. But anecdotally, we have heard of deals falling out, people asking for discounts. With the rapid rise in debt costs, I would expect activity, especially in Q4, to cool, kind of that wait and see approach. But there are multiple factors going on here. Money has to get deployed no matter what. People need to spend money. They're trying to find investments in what is the least worst option right now, whether it's stocks, bonds, or real estate. So we'll have to see how that flushes out. Nationally, pretty similar picture here, strong sales volumes through 2021 and 2022. Maybe we're reaching a cooling right now, but we'll really take Q4 to see that trends, whether or not that's true. In terms of sales volume by market, this looks at activity during the previous 4 quarters. LA is, kind of that top 5 to 10 number. And what I would say is during the pandemic, you have seen a relative shift, greater investment activity to some of those Sunbelt markets like Phoenix, Atlanta, and Houston. Certainly they were among the most active markets pre-pandemic too, but in terms of their share of the pie, I think it's growing relative to markets like LA. terms of the outlook for pricing, I think this certainly is a question in terms of where things are going with the rapid rise in interest rates. But we do anticipate kind of a flattening out of pricing here before gains continuing. That, assumes kind of a moderate, a relatively benign economic scenario at this point. It doesn't call for a strong recession. So, it's definitely up to some uncertainty here as to where we go with pricing. I'll stop here and see if anyone has any questions on multifamily before I get into the office sector. All right, let's talk office. So office has been bad during the pandemic, was bad in 2021 when those other sectors are doing bad, and it's still doing bad. Not much good to talk about here. Seeing definitely vacancy continues to rise. We're at record levels, high levels of sublease space. This graph is interesting. It looks at gross leasing activity. So this is the square footage of leases signed during a respective quarter. So brokers are getting deals done, and there is that activity. But at the same time, we are seeing tenants move out upon lease expiration. We're seeing tenants vacate space and put it up on the sublease market. So vacancy continues to rise, even though we are seeing relatively robust leasing activity, at least relative to history. Nationally, I think that this graph here shows a pretty similar picture. Now, looking at supply, demand, and vacancy, like that graph I showed you for multifamily, we saw vacancy rise quite considerably in 2020 and 2021. The rise has cooled in late 2021 and into this year, but I don't see any relief for the office market anytime soon. Vacancies are expected to stay elevated for sure, and I think there's a lot of questions now with the economy. Some may think that that will allow companies to pull people back into the office. I take the contrary opinion that people are going to be cost conscious going into a recession. If that's the case, they're going to try and conserve on space because real estate is the second largest expense for a company after payrolls. So that will be an area that I think that they will try to cut, but definitely up to debate. Nationally, pretty similar picture here. Most markets are doing pretty bad, particularly those the largest, most coastal markets. Those are definitely outperforming or underperforming, I would say. Sunbelt is seeing a bit better performance there, but it's not like it's great. Now, this graph looks at vacancy by the various major submarkets in LA. In big picture, most tenants have options in most areas of the metro. Vacancies have increased considerably in most of these areas of town. The San Gabriel Valley stands out as an exception. Burbank has vacancy still under 10%, but that's risen by a couple percent in the last 2 quarters. So there's pretty much weakness in almost everywhere in the market, and certainly more than where we were pre-pandemic. So this graph looks at sublease space. And so sublease space represents a tenant who is committed to a lease and they have to continue to paying that, but they're trying to get another tenant in there to backfill and pay at least a portion of the rent. They're trying to recoup costs. This is definitely not a favorable signal for the market because that means that there's kind of a slack in demand and that this space also competes with directly listed space that landlords have, and that this space is usually offered at a discount because you can't negotiate term, you can't negotiate build out. But if tenants want to find relatively cheap space, they typically do that in the sublease. You can do that with sublease space. And considering that space is double where things were in the pre-pandemic, this will definitely create slack in the market. And this will have to improve before we see office conditions materially improve, in my opinion. Now, in terms of the outlook, we're pretty bearish for the office sector. We do expect office vacancies to continue to rise into 2023 before starting to see things kind of go back down. But even years out, we see vacancy far above where things were pre-pandemic. I think that's personally my opinion. I would expect that to be the case. I think we are seeing a new normal. I don't think the office sector is dead by any means, but we're seeing a net contraction in demand. Some firms are going remote, some are going flexible. I think that creates a net contraction, even if people do continue to have office footprints, and some are going fully remote. So I don't think it's a good picture here. That being said, too, I think we're going to see more winners and losers with the office sector. High quality locations, high quality buildings, particularly a low rise, kind of creative, cool outdoor space, kind of that indoor outdoor Southern California lifestyle. Those will do better. I think some of the downtown towers and more traditional 80s feeling buildings will underperform. I think one of the clear signals of that was the news that came out this summer around Union Bank Plaza in downtown LA. That was originally purchased for $208 million in 2010, had an offer fall through at 165. The latest offer is at 155. 155 million, so 220 per square foot for a downtown LA office tower. That'd be unimaginable a couple of years ago, and that was supposed to close last week, but we haven't seen that happen yet. So may even be more of a discount coming, just because there are these questions of who is going to use this space. And I think when you're going to have the slack in the market, there's going to be a flight to quality for the tenants that do want to be in office space. So those kind of average marginal buildings will probably not perform as well. Now, in terms of rents, we have seen asking rates hold flat for the past year and a half, but this is asking rates. And based on anecdotal deals we've heard, certainly offering elevated concessions with 3 months rents, higher tenant improvement packages. But on the face, landlords are trying to, relatively hold face rates and hoping for better days. I wonder when that's going to break. Now, in terms of rent growth, pretty weak across most markets. LA is not on here because it's in the middle of the pack. I think growth was around 1.2% as of the end of the third quarter. You are seeing a handful of markets see strong growth, particularly those higher growth Sunbelt markets. So you are seeing more positive office demand in those locations. And you also have seen more people go back to work in the office in a lot more of these Sunbelt markets. I think there's some politics and industry mix into play. I think more blue states, more tech focused, those will be more receptive to working from home, whereas I think more red states, more traditional industries will be less receptive. And so that could also start to see trajectories differ by market that way. Now, in terms of what office space has been completed, we saw just under 2.5 million square feet of new office space deliver, a handful of projects, some of them fully leased, some of them vacant, definitely a mixed bag. So, just kind of a picture, a mixed picture in terms of what is delivered. Now, when you look at the supply as a percent of inventory, again, the blue bar represents the percentage growth. The number represents the absolute square footage added, relatively in the middle when you're looking at other markets. This graph looks at starts, the yellow line of thousands of square feet of projects that kicked off construction versus the space that is still underway, the blue bars. Developers have clearly exercised more caution since the onset of the pandemic. Definitely less starts of office projects. And we are seeing construction levels continue to decline from a recent peak of just under 9 million square feet. We're now around 4.5 million. So things are cooling down, and I would expect that number to continue to decline based on what we're seeing with starts. And I bet you starts will kind of continue at a similar pace, pretty minimal. Nationally, definitely seeing a similar picture there, but to a lesser extent. There still is more construction underway on a national basis. In terms of what's underway, we now have around 4 million square feet. That puts us, in the 11 to 20 range. But when you calibrate it to the size of the market, it's pretty minimal. Construction is in specific areas of town. Certain areas, it's not an issue. All certain areas, it is. Also depends on the quality segment of space that the tenant is looking at. In terms of sales volume, definitely have seen activity trail off for the most part. So there definitely are some reservations in the sales market in terms of the office sector. There has been up until now a very interesting divide where there have been some sales that surprisingly to me have really not seen much of a discount. One of the more recent ones was 555 South Aviation in El Segundo. This was that kind of cool creative flex space. Went for an under a 5 cap, I think around 800 a foot. In contrast, that Union Bank Plaza just shows you the story of have or have nots. So it's about what the quality of the building is, the tenants that are in there, the lease roll, credit, if the tenants have credit. All those factors are clearly showing in terms of whether a sale result is seeing strong pricing or weaker pricing than we would have expected pre-pandemic. Now, in terms of the outlook, I think that we do expect pricing to kind of hold flat here, a bit decline. I think between the haves or have-nots, though, there definitely are going to be some serious discounts that are going to come. I think this is probably a bit optimistic in my opinion. I think there's been a little bit of a kicking of the can down the road and hoping that we get back to the office, things would normalize. I think we're seeing what new normal is right now. And I think that the optimists probably got ahead of themselves. So definitely some uncertainty here, but I do think there will be that divide. There still are, capital allocations towards office. People need to deploy capital, particularly at the end of the year. You often see that rush to buy a building, and there's motivations there. But by and large, I do expect kind of a bearish outlook. Any questions on office before I go into industrial?
Hi, this is Sam. Question, do you see any kind of office conversions going around anywhere in the country?
Yeah, and there's a lot of chatter about having that be kind of the saving grace. But the issue, particularly when you're looking at CBDs and these office towers like the one I'm sitting in right now, the configuration doesn't really make sense for residential. The distance from the core to the windows, so where the elevators are, they're much deeper than what you would build residential. So you would end up with these very long, narrow spaces that really isn't attractive and probably not workable in many scenarios. Smaller buildings, older buildings, they are often prime opportunities for renovation, but that's only going to be a sliver of the market. Kind of low-rise suburban, maybe that's a better prospect just because you can knock it down and build multifamily. So I think that will have a limited impact in terms of how we evolve in this post-pandemic world with a weaker office demand.
Okay. All right, thank you.
All right, so let's go to the industrial sector. Definitely the most positive sector to speak about, but we are seeing some signs that conditions are moderating a bit. But this graph here, looking at the leasing activity, we did see activity weaken in the first 2 quarters, saw a little bit more kickback in Q3. So that's, kind of interesting there. Seeing very strong activity still on a national basis, but I would say to some degree, vacancy was so low in the beginning of this year that a lot of that less leasing activity was almost a result of less supply than less actual demand. There's just only so much space left. When you're talking sub 2% vacancy, that's really no vacancy because there's going to be a certain small subset of the market space that's out there that just isn't really usable for a lot of tenants. So very limited options, even though we've seen vacancy uptick here a bit in the last 2 quarters, but this is still one of the lowest vacancy rates among markets nationally. So still very tight, still should propel rent growth in the coming quarters. We are seeing rent growth cool from peak levels, but things got really kind of crazy in the first half of this year. So it's all reasonable to me. So when we compare where things are nationally, it's a pretty similar picture here. Vacancy did make an uptick in Q3, but historically on a national basis, this is near the tightest the industrial market has ever been. So still seeing relatively landlord favorable conditions across almost every market in the nation. I do want to point out, this is our daily vacancy rate here. And so I think it is pretty clear that, vacancy has increased since April. But when we're talking under 2.3%, still limited, it's still a landlord's market. But if we do continue to see that increase, that may be more concerning to me, but I'm not too concerned just yet seeing this. There's even pre-pandemic, there's kind of a bouncing around in vacancy within 0.5% or 1%. Strong rent growth continued then, some of it's just kind of moving pieces of tenants moving, the timing of them moving in and moving out. But I could be wrong in a quarter or two, so I'm going to continue to watch this for sure. In terms of the outlook, again, I think this is pretty favorable here. We see vacancy kind of staying right where it is for the next several years. Not particularly strong demand, but what LA has is not a lot of supply. Typically, it's a very hard market to build, so we don't see the supply that a lot of other markets do. So that will probably help keep vacancies in check if there were to be an economic downturn, which I think a lot of people are expecting now. On a national basis, we do see vacancy increasing, but still relatively strong conditions here. But there are, there's higher levels of construction on a relative basis in most other markets. So that's what's going to lead to this relatively higher rise or increase in vacancy compared to what you're going to see in LA. In terms of rent growth, it's just been exceptional up until now. around 15–16% in Q2. Things are starting to moderate at this point, that's for sure. But on a year-over-year basis, the gains are still pretty record-setting. And looking at rent growth by market, LA and the Inland Empire, because I really kind of see them as complementary and really related to each other, continue to be top performers. And it's really impressive considering they have really been among the top performers over the past decade. They saw higher rent growth earlier on in the cycle, in the middle of the cycle, and even today. Usually there's a bit of catch up among markets. So I think that really speaks to the strength and the vitality of Southern California as an industrial market. In terms of our outlook, we do see rent growth continuing to moderate, but this is still going to be historically strong, at least for the next several quarters. So a pretty favorable outlook here. In terms of the outlook for rents, just want to point this out here. I think that certainly there's a debate, but in terms of relativity, our numbers, our forecasts show that LA and Inland Empire should continue to be top performers, which again is more impressive because this has been this case for a long time now when you compare to the other markets nationally. What's under construction, we see a lot higher levels of construction in most other markets. Just want to point out Inland Empire here with 17 million square feet. So it's towards the higher end. LA is not even on this list, and we are one of the largest markets nationally. It's just too hard to build here. It's too expensive. There's often a higher and better use for that land site. Historically that has been office and multifamily, maybe office less these days, but certainly multifamily is a prime target. We have seen some interesting deals where investors have purchased low-rise office sites, a few in the South Bay, to convert to industrial. So there is this interesting dynamic now where in some instances industrial is higher and better use, but there's still limited land sites. It's still hard to build it, even with crazy record pricing, strong investor demand, all of these issues. There still will be a measured pace of new industrial supply in the market in the years to come. And so again, looking at what is delivered over the last year here on a relative basis, only 1.6 million square feet. That's a drop in the bucket. Supply really does little to impact the market in LA, and it has been this case for a long time. Now looking at this graph of what is starts in under construction, like I showed with the various sectors, has bounced around at pretty similar levels in terms of construction levels and starts. Q3, we didn't see any projects kick off, but that's just one quarter, so I wouldn't read too much into that. I think that given the strength of the market, but given the limitations and difficulties to build, I would expect a pretty similar construction pipeline to persist in the coming years. In terms of nationally, much more dramatic increase in supply during the past 2 years. We're at record levels in most markets nationally, which has been completely justified in terms of demand, and demand has been here. But with these questions with the economy, I think it does make the point to contrast with LA, and that these other markets will likely be more susceptible than LA if the downturn does kick in. Now, in terms of what's under construction, very limited in LA. I think around 4.5 million square feet. Continue to see very high levels in other markets. So just kind of pointing that out as a contrast. So when you look at LA on a relative basis, very, very minimal construction levels right now, especially when you contrast to other markets. Sales activity has been just insatiable up until now, I would say. Q3 is the second highest level. There were some major national portfolios that traded. So I think that artificially inflated that number relatively a bit. I think if it were just traditional sales, we would have seen a cooling. I think there definitely are some questions in terms of the sector, just considering how heavy pricing got, seeing sub-3 caps, that you can only justify when debt costs were much lower than today. Now the situation, if you were to buy a building with that kind of yield, we're talking negative leverage. Not that means a price crash by any means, but probably a pausing and a figuring out of what's going on, because sellers have this number in their head, buyers now have the increased debt costs. And so I think it'll take some time to flush out what that means for pricing. Sales activity in LA and the Inland Empire continue to be prime targets. Definitely, one of the most highly prized industrial markets nationally. We have among the lowest cap rates. LA, IE, and I'd say Seattle have the lowest cap rates nationally. So really, a lot of compelling reasons to invest in LA, given the limitations in the inability to build quickly in new industrial space, the ports and access to ports, the access to the strong population densities that we have in the LA basin and in Southern California in general. So all of those reasons really substantiate the demand that we have seen for industrial properties by investors. In terms of the outlook, we are calling for price increases. I think there's a lot of, any sector that we're looking at here, a lot of uncertainty when it comes to the trajectory for pricing. This the swift rise in interest rates and increased debt costs, this caught everyone off guard, even the economic experts. And so there's, just a lot of question marks in terms of where we're going to be going in the coming quarters. Does anyone have any questions before I wrap up with retail? All right. So retail has, there's been some what I call green shoots, or some sources for relative modest optimism, I would say, in LA's retail sector and most markets nationally, which is good news considering, since 2016, there's been this chatter from, 2016 to the pandemic. There was all this talk about the retail apocalypse. Wasn't true, but there clearly was weaker demand, and there was kind of a net contraction in the retail space we needed in LA and nationally. But LA or retail has gone through an evolution in recent years, and it is going through a right sizing. And so I think it's hard to paint the sector with a broad brush. I think there's certainly a lot of commodity retail that we don't need, but there is also a lot of successful retail in LA too, whether it's high quality mixed use centers, or local neighborhood strip centers in areas with good demographics and solid tenants. So it is a bit of a mixed bag, and it's hard to talk about this sector in one full swoop. But this graph here looks at gross leasing activity, the square footage of leases signed, seeing activity kind of in line with where things were pre-pandemic. So pretty favorable, but not really strong activity either. But that's fair and what I would expect. Nationally, pretty similar picture here. Things are back to where they were pre-pandemic. Now, when we look at the supply, demand, and vacancy graph here, we have seen vacancy decline ever modestly during the last year and a half. So that certainly is favorable. But things are still relatively elevated to where they were, pre-pandemic, or in 16 or 17. That was kind of the strongest years in the last decade. So definitely some positive momentum, but we are still talking about a pretty stratified sector. And so it's really about what specific area of retail you're talking about in LA, whether it's healthy or not. Nationally, I think the trends in LA have pretty much the trends in the nation have mirrored LA. I think some other markets have performed better and more robust gains, particularly those high growth Sunbelt markets. There has been, greater population growth, home building, people moving to the suburbs. And so there has been relatively more vitality, I would say, in some other markets, but LA still is performing well, especially considering where things were a year or 2 years ago. In terms of net absorption, LA saw 1.6 million square feet of net absorption. That's pretty modest when you consider the size of the market. So again, these graphs like this one looks at the absolute level and comparing that, whereas this looks at it on a percentage basis. So relatively limited net absorption when you consider how large our market is. And as you see on the other side, those high growth, San Antonio, Phoenix, Fort Lauderdale, those areas are kind of, where we're seeing most of the net absorption. In terms of the outlook, we do kind of expect steady Eddy conditions. But again, you got to talk about retail, and there's many ways to slice retail. And this is just talking about the market on a market-wide basis. In terms of the outlook, we do see continued gains, and things actually we're seeing around 4% rent growth here, so that's relatively favorable. Not that that's that great, especially when we consider it's inflation adjusted. It would be negative, but compared to where we were, that's relative modest optimism in my book. In terms of gains, we are kind of towards the bottom middle. Again, you're seeing more of those Sunbelt markets are seeing more robust rent growth at this point. In terms of what net deliveries, LA is not on this, just want to show that other areas are seeing more construction, but pretty modest, I think, in most markets, even ones with Dallas and Houston, just considering the population growth they see year in, year out. In terms of what has delivered in LA, again, on that relative basis, a sliver, very, very little net inventory growth going on in the market. You do see projects, you do see modest construction levels, but you also see properties demolished to make way for higher and better uses. And so there's that resizing that we're seeing of slowly flushing out what I call the bad retail that we don't need, while we still continue to build good retail that resonates with the consumer, mixed use, high quality, something that gives the consumer a reason to leave their house and not just shop online. There's 1.6 million square feet of retail space under construction. That is pretty modest when you consider we have over 400 million square feet of retail space. And this graph here, again, looks at starts and what's under construction, very minimal levels, which has been the case for years. Since 2010, 2011, we really have seen essentially no net new supply growth in LA. We've seen construction, but we've also seen demolitions. And so it's been very flat when it comes to inventory during the past decade. Sales activity has been relatively strong here. I think that there's a mix of what's going on. There has been demand, especially up until the rapid rise in interest rates, for triple net lease properties, credit tenants, the bond-like real estate. That was supporting the market for a bit. I think, a good portion of this is also properties purchased for redevelopment or, what we call value add strategies. So definitely some more risk, people willing to take more risk. But what we're seeing in these numbers now are decisions made several months ago. So what impacts are happening today are really, it'll take a few more months to see. So I'm sitting here waiting to see what's going to happen. But right now, so far, sales activity continues to hold up pretty well. In terms of the outlook, we do see kind of, flat gains for the next several quarters before kind of very modest growth over the long term here. But this is sector-wide. Again, you got to look at retail in its various segments, various locations, because they all, all these sub-segments perform very differently. So that is all I have in terms of slides. Before I open for any questions, here's my contact info. If anything does come up or you do just want to, talk about what's going on in the market, please feel free to give me an email, give me a call. That's what I'm here for. I'm a resource for you. But thank you all for your time. And does anyone have any additional questions?
Good presentation, Ryan. Thank you as always. That was very thorough and kind of give us great snapshot of what's happening the last few months, right? Thank you as always. Ryan, do you want to lead us to the next presentation?
Yeah, or Ricky, you want to?
Sorry, Ricky.
Sure. If you can just transfer me can I share my screen?
Yeah.
Okay,
I
cool.
don't think I can, I think.
Okay. Can you guys see CoStar?
Yes.
Okay, great.
And sorry, I got to drop off. Thank you all.
Thank you, Ryan.
And I'm sure I'll see you again soon.
Thanks, Ryan.
Bye.
So just a quick, a few things on CoStar. As Ryan was saying, like as far as his contact information, like if you ever have questions on your listing, like on the end of mine, like on your CoStar contact, you should see my name there. And then if you ever have questions like on a listing, if you need to change anything, you should have a client relationship consultant right there at the bottom of your CoStar, which they can also help you with anything like that, as well as I can, but they can make changes immediately. And anything listing related, it should really go through your client research consultant. And then if you ever can't get a hold of me, you can always call support if for some reason you can't get into your CoStar. But just wanted to point those out. As far as there's some new things on CoStar, like if you're in a search, let me just go into one of my last searches here. It's not letting me here. So if you go to your properties, and let's just choose You want to say retail. One thing that you can do is you can sort out like when you're, as far as this loan feature, you can see the active loans in a given market. So if you click on that, and then you can, for example, if you want to see your CMBS loan here, so it'll give you all this information as far as if it's been on a watch list or looks like this one just joined it. You can see all the commentary right here. Okay, on all the loan origination, and then you can also then see the financials. So the financials, if it's not a CMBS loan, you would just see how it just has the market, but we actually do have the property financials when it's a CMBS loan. So I just wanted to point that out. And if anyone ever has any questions, I can do a one-on-one Zoom. I've got some Zooms scheduled coming up tomorrow with Colin and Carla, and then anyone else that ever needs anything, I'm here. Okay. Anyone have any questions?
It's a quiet group.
Yeah.
No questions? Okay.
Okay. Well, Meny, thank you as always for having me on. I look forward to seeing you and others tonight.
Yep.
And again, thank you very much for your time, and have a great afternoon, everyone. And Kim, if you could send me like who joined today so I can share that with Ryan. And then if anyone needs a copy of his PowerPoint, I can get that out to you.
That's awesome.
Sounds good.
Okay. All right. Thank you, everyone.
Thanks, Ricky, as always.
Yeah. Yeah. Bye-bye.
Yeah. Guys, any other questions? Anybody has anything to add? Any kind of wants, needs you guys want to share with us?
It was a great presentation, Meny. So thank you. Just the graphics of the trajectory, really paints the picture on commercial. So, thank you for bringing them on board.
Yeah, they're doing a great job to also analyze everything through, cross industries, not just like one type of commercial. So it gives you like an idea, and it's a complementary, like it just makes sense. Give you like a whole picture of what's happening locally in our backyard, right? So it's important to have that for sure. Thanks, Ricky. Anybody else? Anything else that you have to you want to share, want to add, wants, needs? Kim, who do we have the next meeting?
Our next meeting is that's with Andy. He's from U.S. Capital Funding. So he's going to talk about some special loans programs that he has for commercial.
Yep. And that's November 8th.
That's right.
It's a Tuesday, 1 p.m. as always. So yeah, a couple of weeks from now, which is also election day. That's exciting day, right? So awesome. Well, thank you, Kim, for setting this up. Thank you, everybody, for joining us. And this is recorded, so you can watch this session afterwards on the channel later on. See you later.
Thanks, guys.
Thank you.
Bye.